Great, thanks, Roland, and thank you very much for inviting us this evening. It's a great lineup, and I personally, anyway, I'm looking forward to listening to all the other presenters once I'm done here. Firstly, say good evening, everyone. Thanks for joining us to talk about the JPMorgan European Growth and Income Investment Trust. I'm Tim Lewis. I'm a portfolio manager on the trust, along with Alexander and Zaina, who you see pictured in this slide. Alexander has managed the portfolio since the early 2000s, while Zaina and I joined him on the strategy in 2020. I think we have a number of shareholders on the webcast, but for those that aren't as familiar with the trust, from 2006, the trust had been run as two separate portfolios, an income leg class and a growth or core share portfolio. In February 2022, the two portfolios were merged, with the decision going forward that the portfolio would continue to be run with the investment process of the growth or core strategy, but with an additional enhanced dividend yield. And this additional enhanced dividend is a targeted 4% dividend yield set at the start of the financial year based off the NAV at that time and paid quarterly. And we think this is a very attractive attribute for the investment trust, taking advantage of the structure to pay the dividend without compromising the investment strategy of the portfolio. Ultimately, what we are trying to achieve from this portfolio is consistent and risk-controlled alpha generation from a portfolio of continental European stocks. And one that is balanced, and this is a very important point for us, one that is balanced to perform in different market conditions and when different styles are performing. And we think that is largely reflected in the performance you see on the right-hand side in the bar charts. The past 10 years have seen, considerable volatility in the European macro. We've had political volatility, we've had a global pandemic, we've had a war literally on the continent, and throughout it we've had very differing market performance and different style leadership that's impacted. And throughout that we've had a pretty, what we would see as good absolute returns with NAV plus 8.8% per annum over the past 10 years, and share price returns up 9.2% over the same period. And it's also been a period where the outperformance versus the benchmark has been consistently earned, with no significant drawdowns or massive spikes in our performance. So how do we go about achieving those objectives? And essentially, what do we use as the first start of our process for identifying attractive companies to invest in? So our process combines both quantitative and fundamental analysis. And as portfolio managers, we are looking to extract the most from what we see as being, incredible resources we have within quantitative research in JPMorgan, and also a global team of sector specialist fundamental analysts providing us with proprietary research that only we can see. And again, this is a key differentiating aspect of our trust, sort of the wealth of resources that we have to pull on and take advantage of. So for example, our equities platform spends $150 million annually on their internal fundamental research effort. And that is, that is spend that we can pull on to improve our insights while also taking advantage of everything that is out there in the market. Similarly, our quantitative research capabilities are very well established with their own impressive track record and a history of innovating to keep themselves ahead of peers. So ultimately, it's about how we put these two analytical tools together to get the most out of both. And we believe the two complement each other well. For example, the quantitative research arm allows us to analyze over 1,000 companies daily in a rigorous and repeatable way. It allows us to screen for companies that we think maybe justify more fundamental analysis and a deeper dive, but it also allows us to look at our own portfolio in an objective and an unemotional way and really test our own biases. Now, on the fundamental side, it's both the internal research that we have and our own fundamental research that portfolio managers utilize to dig deeper and get that deep stock-specific analysis that is also more forward-looking and contextually aware. So what are we looking for in that process? I think first and foremost, we're looking for high-quality businesses, and by that we mean looking for businesses which have good and sustainable return on invested capital. We're also looking for companies where their earnings per share translates to free cash flow for the company without dodgy accounting irregularities. We want to invest behind management teams with a track record of sensible capital allocation decisions, or at least new teams where they've articulated their plan for capital allocation well. And also we want to be testing the duration of these attributes because, especially as we've seen over the past couple of years through the pandemic, there's been business models and specific stocks that have done very well through the pandemic or through the opening up, but it hasn't lasted. And so a very important part of determining whether it's a quality business is whether that is long-term in its nature. In terms of valuation, it's important for us to work out when the market has completely assessed and discounted the future prospects already in the price. It's all well and good identifying the best quality companies in our index, but if they're already priced for perfection, then there's no ability for us to make money off that idea. So we are honed in on where is our research showing us ideas that the market is incorrectly priced. And lastly, and very importantly for our process, we're looking at companies where the operational momentum is improving. And I think the easiest way for us to assess that is by looking at management guidance or earnings per share forecasts to see whether those are being upgraded or downgraded over time. But there are also other more nuanced ways that pull in some of that quantitative approach. For example, assessing the tone through management calls with sell-side analysts, or by looking at a more aggregate level at global peers or at an industry level to try to assess where we think operating momentum might be slowing and where we might justify more fundamental work to really determine whether we've hit the best of things. Importantly, not all companies that we invest in will have all these attributes, but what we're looking for is for the portfolio on aggregate to be higher quality than the market, to be cheaper than our benchmark, and for the underlying companies to display better operating momentum than the average. Ultimately, then, we need to bring those stock ideas and balance those stock insights with appropriate risk management. We do that using proprietary tools and also through third-party tools, trying to analyze the portfolio through many different lenses, and also as a way of identifying key risks, key macro exposures, and also producing scenario analysis under conditions that we would expect the portfolio to perform. Today, you'll see no sector deviates more than 2% from the benchmark. Currently, we are overweight the semiconductor sector, and specifically within that, a number of the semi-cap equipment names, 2 stocks in particular, where we believe they have a very strong market position and technological advantage, being ASML in EUV lithography needed for leading edge chips, and in ASM International and their atomic layer deposition. We're also overweight some consumer exposed companies where we see rising real wages, falling inflation, and the accumulated savings that haven't yet been spent in Europe, all adding up to an improving consumer backdrop, and we're seeing that in consumer confidence. On the other side, we're underweight healthcare equipment, where we see some stretch valuations and mixed operating momentum. And we're also underweight materials, probably an area of the market which we see to have been more structurally impacted from the Russian invasion of Ukraine, and in particular what that's meant for energy prices in the region, thinking about some of the heavy industries that we have in Europe. It's also apparent if we look at a stock level, and you'll see what we believe are active sizing to be large enough to show conviction and to generate alpha at a stock level, but also balanced and diversified through the portfolio. And I think something that's important for us is when, rather than going through every single one of these names, it's probably the themes that come out. And the fact that I would point to is, if, for example, if you look at our top 5, there is no theme. So Novo Nordisk, a Danish pharmaceutical company with a leading position in diabetes and weight loss drugs. Wolters Kluwer, a Dutch media company with a big US footprint and strength in tax and accounting software. Inditex, the Spanish conglomerate, fashion retailer and owner of Zara. Publicis, a French advertising company, with seeing real tech strength leading to wins, and Munich Re, a German reinsurance company, seeing pricing ability from a tight market. And that's more just to say, this is 5 different countries, 5 different subsectors, multiple different drivers of performance. So when we look at our top positions, it isn't obvious that we are particularly leveraged to one macro theme or one thematic in general. But potentially a more interesting way of kind of discussing the sort of stocks that we like to invest in is through this slide. And we do build our portfolio from the bottom up, but certain themes emerge, and we've highlighted some of these on this slide as sort of companies that we're invested in today. And I think what's important for us is that these themes represent long-term structural growth opportunities, and ones where European companies are very well positioned to take advantage, and if not, are industry leaders already in those themes. But the idea isn't for us to be a thematic fund and invest behind the theme. It's through our bottom-up stock analysis where these opportunities emerge. We want to have exposure to that additional growth that comes from the structural angle, but doing so in a diversified way. And hopefully you'll understand what I mean if I talk through some of the examples. So take, for example, the increasing share of wallet that we are seeing consumers allocate to health and well-being spend, and that ranges from fitness and wellness activities to nutrition, and into the companies that we have here. So Novo Nordisk, as I mentioned earlier, our largest holding, with their pioneering weight loss drug, Wegovy and Ozempic, which you've probably heard about. There's been many an op-ed written about. It's been the talk of both the Oscars speeches and also dinner tables around the country, I think. And as much as we like all those discussions, the key for Novo is it's got a real societal benefit, dealing with the obesity epidemic globally, and also we're now seeing further cardiovascular benefits that has come about from the drugs. You take a stock like L'Oreal in a different sector in consumer staples, they have a leading position in skincare with pharmaceutical ingredients, and just like they did with e-commerce, they've kind of taken the leading position and kind of stolen a march over the competition in the area of their sector that is growing the fastest. And we think that creates a real virtuous circle, because they then have the best data to be putting into new products. They have the most money to spend on marketing and advertising, and they have the most capital to allocate to future R&D. And so again, a different way of playing the same theme, but we still see it coming through. EssilorLuxottica, another one, not a very well-known name, but it's the owner of a number of glasses brands like Ray-Bans and Oakleys, and I promise you will have heard of all of the different brands that sit within the company. And again, that's the growth from them is coming about the utility of our glasses. So whether it be implementing hearing aids within glasses, or whether they've innovative new lenses to help control for myopia, or the smart glasses that they're now producing with Meta. Low carbon transition, another one where European and to be fair, probably Chinese companies are leading the way. I think, partly driven by the industrial strength that we've always had in Europe, but also probably to do with it being high up the political agenda in Europe. And really, we could have chosen a whole host of companies from our portfolio that benefit from this low carbon transition and the need to decarbonize our society. That ranges from utility companies that are building renewables and building out that infrastructure, to chemical companies who are helping to decarbonize, like Air Liquide. Also, some of the autos companies and helping that rollout of EVs. But here we've chosen 3 industrial companies, which we see as the sort of picks and shovels play, I suppose, electrifying our grid and really building out the infrastructure that's needed for the electrification of society, whether it be through charging points like you see for Schneider Electric, or through the undersea cables that are required, or through the maintenance of that. We're overweight banks in our portfolio, and when we talk about interest rate normalization, we don't necessarily mean that rates have to go higher from here. We don't even mean that rates need to stay where they are, but rather we expect that rates will be higher on average in the next decade than they have been in the last. And I think the 15 years post-financial crisis has been a catastrophic period, I suppose, for European banks, and under incredible pressure from regulators, and with long-term interest rates that seemed on a one-way slide. And now we've kind of come out of the pandemic. Inflation has obviously dominated the conversation to an extent I think that central banks will forever be scarred by, or at least will be for the next 20 years. And the European banks, ironically, have come out in a really strong position, because the capital build-up that was forced upon them post the global financial crisis has now resulted in really well-capitalized European banks that are better than their global peers, in honesty. And we are seeing that particularly as a valuation opportunity. Where we are seeing shareholder returns and share buybacks, a lot of that is coming from the European banking sector. And it's not uncommon for us to see 12 to 15% shareholder returns per annum, and we've seen that across a number of names over the last few years, and we believe it can continue as they are now generating, they're now generating profitable returns and building up their capital and are in a position to then give that out to shareholders. And lastly, we mentioned the consumer, and here I think mostly this comes again around a valuation opportunity, or a misunderstanding of where both the global consumer is and particularly the European consumer. I mean, the European consumer has kept savings rate higher than most other areas in the world, partly driven by, just as we are entering out of the pandemic, and we had this opening up at the same time Putin invaded Ukraine, and we had this big spike in energy prices, which really kept everybody very cautious in Europe for a bit longer than happened in other regions. And so we're seeing, that there's still that capital to be deployed from private balance sheets, but also, as mentioned, real living wage growth. We are seeing inflation continuing to fall, or at least steadying from here, and the consumer confidence improving from this position. But it's also a sector I think we find a lot of idiosyncratic ideas, and we've picked out a few of them here. I mean, LVMH is probably a well-known company to most, and it's one of the highest quality businesses in the world, in my opinion, and it's one with a very strong track record of compounding sales growth and improving margins. And we believe the valuation has been impacted at the moment partly because of a very successful pandemic period they had that maybe the market's concerned about, and also jitters around China. But I think this is, one of those names where you'd look at a very quality business and who's got a proven track record of accessing new markets when they need to, and where we're seeing, at a ground level, demand for their products not really changing that much, and see this as an attractive entry point. Ryanair is probably self-explanatory for anybody who's tried to book a flight in Europe in the past 18 months or so. I know it's affected me getting back to Dublin quite a bit. But a lot of travel and leisure companies have done well through this pent-up demand to get out and travel again. But I think Ryanair more than most, because Ryanair acted counter-cyclically through the pandemic. So while the indebted national aircraft carriers were contracting, Ryanair was adding to their fleet with the most energy efficient fleet. It was retaining their staff so that they didn't have the issues rehiring, and they were picking up slots at airports, which has given us, unfortunately, from a consumer's point of view, but good from a shareholder's point of view, incredible pricing power now going forward. And Adidas, we see again one of those idiosyncratic stories, a great turnaround story where a new CEO's come in, and that's been complemented by having the right product at the right time, that's really capturing the attention and the imagination of consumers. And it's really bucking the trend from what they're seeing from almost every apparel retailer, but especially their biggest peer, Nike, which is struggling. Whereas we're seeing real strong operating momentum from Adidas, and one that we are happy to invest behind at this point. So I think, in conclusion, there's kind of three key features that we think distinguish this investment trust. The first is, what we mentioned at the start, the disciplined, repeatable investment process that harnesses the best of both quantitative and fundamental analysis. And this has been crucial in generating the returns that you see on the top left, with a 10-year cumulative return that's actually above 130% if we look to the end of February. But the second, and importantly, is how that track record has been built in different market environments. And it's worked in both up markets and down markets. And if we take this bar chart on the right, what you'll see, for example, is in months when value has outperformed growth, this trust has outperformed 68% of the time. In months where growth has outperformed value, growth stocks have outperformed value stocks, this portfolio has again outperformed 68% of the time. So it's that consistency across different market environments that we think is really resonating with people at the moment, especially at now with market leadership quite volatile, and with different styles leading the way at different points and changing leadership very quickly. And lastly is on that bottom left, that attractive yield and the enhanced dividend policy as part of a number of JPMorgan investment trusts within this suite, with an enhanced dividend policy. And really we look at that as something that offers reliable quarterly income, but that is done without compromising on the return of the portfolio as a whole, and one that doesn't impact our stock selection or portfolio construction decisions. So thank you everyone for your time. I will conclude there and hand back to you, Roland, for any questions.
Lovely, thank you very much indeed, Tim. We're slightly on the edge of our time limit here, so I'm going to ask you a couple of very quick ones, if that's okay, Tim. So first up, question came in quite early. Could kindly explain why you continue to hold luxury market consumer goods as due to changing tastes in China? Do these seem overvalued?
No, I think short answer, we don't see. We did reduce slightly, and we were maybe conscious that we had, quite a big position built up over a number of years in luxury, and it's been a strong performing area, particularly through the pandemic, as people talk about revenge spending and wanting to go out and buy that handbag because they couldn't travel. We actually think valuations have come back quite a lot in the area, and while we are concerned about China, we're also, enthused by what's happened in the US and then potential for new markets in India and in the Middle East. And these luxury names usually have a way of reinvigorating the brand.
Thank you. The next question was about market cap size. Do you have a limit on the value of the size of business that you consider investing in? I guess that's a floor limit.
Good question. We don't. We would look at all. It's not a market cap limit, but we would look at liquidity constraints in general as part of what sorts of position sizing we would want to get in. So we definitely, there's a spectrum. I don't have a hard market cap limit that we'd give, but generally we've been moving more large cap, but we're open to more ideas in small cap as they become available.
And final question then is about the payment frequency for dividends changing from 6 months to quarterly. And was that at the start when you described the trusts merging together? Was that a factor of that?
Yeah, that came from listening to feedback from shareholders, which the great thing for us and the important thing to emphasize is it's not something that impacts us at all. We get a message that says the dividends come out and we notice it in our NAV, but it doesn't impact the type of companies that we want to invest in. But I think we went through a process through that of listening to shareholders and seeing what was attractive for them and really wanting to position this fund to narrow the discount and to build a new shareholder base that hadn't previously looked at us.
Lovely. Tim, we're on time there. Thank you very much indeed. Thank you for joining us this evening.
Thank you.